What's up, chat? Gonna check out Berkshire earnings. They came out this morning. Berkshire's like one of the only companies that reports on weekends. They also updated their website literally like a few minutes ago because these were not highlighted red. Kind of weird. But let's see. So you go to news releases, fourth quarter earnings, and then we'll read Greg Abel's shareholder letter. And what's up, Kai Groth? Kai Groth? What's up, Kai? Hope you're doing good. What's up, Kristen? God damn it, I'm bro. You've been in the stream for too long, Bruno. They haven't dropped the 10K though. That's kind of whack. There's really not much. They didn't really drop much on the news release. So I wonder if they have something else. Holy shit, Jake Waters. Jake Waters. What's up, Jake? Good to see you, bro. Good to see that name in here, Jake. I hope you're doing good, bro. I hope you're doing good. God bless, bro. God bless. Jake Waters, bro. Crazy, crazy. What's up, Jake? Is there... Oh, right here? Ah, here it is. Right? Or is this just the same thing that I already have open? Oh, okay. So they got a whole, like, slideshow. Good lord! There's a lot to read on Berkshire. Holy. What a massive company. There's a lot. There's a lot. I guess we start with the investor letter. Greg Abel's investor letter. Let's start with the... Let's start with this. Because this is nice, short, and sweet. I know. Seeing Jake Waters in here is crazy, bro. I've been good, Jake. I've been good, Jake. I've been really good. Chilling, bro. I hope you're doing good. I don't remember details about Jake for some reason, but remember the name. Jake was he's just one of those guys from back in 2021 who was here like every day. The most bullish Microsoft investor ever. That's what I remember about Jake Waters. He bought a house in the hood and everyone told him he was crazy, and then his house became worth like millions of dollars. Jake Waters is the GOAT, bro. Jake Waters is the GOAT. I remember a few things about Jake, but it has been a long time. Berkshire, I'm never going to invest in. So boring. Yeah, I would never. I mean, it's too expensive, and it already has, like, there's no gain on Berkshire, you know? You're never going to make a double or triple on Berkshire. It's too big. Like, I don't think Berkshire could make enough money to make the investment worth it. If you're already a shareholder, you're double or tripling your investment every single year, basically, probably even more. But, if you invested now, you're kind of screwed. But the reason why Berkshire is interesting is because, what if GameStop becomes similar to Berkshire? And then, you're investing at a 10 billion market cap. What if 5-10 years down the road, GameStop brings in $10 billion of shareholder value in 1 year? You essentially double your investment in a year. And, that's why Berkshire is interesting. And, with Warren Buffett retiring and Greg Abel taking the role as CEO, I would imagine a lot's going to change. So, it may not be like an interesting investment, but it's an interesting business. So, taking the time to research it, I guess, is somewhat worth it. Not if you live in Nebraska. Everyone loves that shit. What's up, Keith? How you doing, Keith? The fam's been great. Today's opening day for the Little League. 84 and sunny on the beach. Gonna watch the 12-year-old play ball today. Like, yeah, Jay. Damn, 84, bro. It's like freezing where I live. It's freezing where I live. What is the weather today? Oh, it's 50. Okay, it's not that cold today. It's getting warmer. It's getting warmer. That's awesome though. That's awesome, Jake. I love it, bro. I love it. GameStop has good asset, but not a lot of profit. Not yet. But it's the only fair value stock on the market, so it doesn't really matter. And yeah, they're gonna pull 700 million profit this year. So what are they gonna do next year? What if they do $1 billion two next year? What if, and what if the following year they do 1.5 billion? That's the interesting part about GameStop is the future. Everyone focuses on where GameStop is right now for some reason, and they don't look into the future. There's not a single company on the market. There's not a single company on the market where every dollar they earn, they retain, as far as I'm aware. Hey, I appreciate that, Jake. Thank you, bro. Thank you. You stay blessed too, bro. I appreciate you, bro. Hopefully I'll see you again sometime, my friend. Stop in again. Even just to say what's up. How will GameStop grow their profit so much? Cutting costs, different business avenues, growing the cash stack. Maybe Bitcoin, maybe they invest more in crypto and crypto goes up. Maybe power packs becomes bigger, repacking becomes bigger. Maybe cards continue to grow and all their inventory from power packs grows in value. There's actually a lot of ways GameStop will grow. And they're also going to do that acquisition that Ryan Cohen was talking about, and nobody even knows what that is. What if they acquire something that is making $2-3 billion in profit a year? There's a lot of unknowns about GameStop, and that's why it's interesting. But despite all the unknowns, the risk, in my opinion, is very minimal. The downside is protected, and that's really what matters, honestly. If the downside's protected, I mean, if the market ever crashes, it's likely GameStop stock doesn't go down unless it's overvalued in the moment of the market crashing. But if GameStop's sitting at fair value while the market crashes, there's a world where you don't really lose. Potentially. I don't know. We'll see. We'll see. The future is unknown, but to me, I think the downside risk is protected, so it doesn't... I'm not really worried about it. Because if I'm not going to lose money on the investment, and so far I've only made money on the investment, so I'm gonna continue to see it through until it stops working, I suppose. But in my opinion, it's never gonna stop working. I think GameStop's gonna make me a multi-millionaire with time. Got to get the kid to the field. One more thing, when people ask me investing advice, I like to say get a long-term plan. Amen, amen. I agree. I agree, bro. GameStop's expected to earn only 80 cents next year. Seems quite little. Well, if you're taking analyst estimates, I think that's a mistake. I don't think analysts understand. $84 degrees sounds good. I know, that does sound good. Better than multi-millions. I say it the way you used to. Get a long term. Have a great weekend. You too, Jake. You too, bro. Thanks for stopping in, Jake. Enjoy your weekend. Enjoy your kids' game. I love it, bro. Yeah, get a long term. I agree. I mean, my long term's GameStop. We'll see. We'll see where. We'll see if it works. We'll see if it works. I think it's gonna work. So far, it has been working, so I'm not too worried about it. Software sector seems beaten up. CRM looks good. Intuit also. I don't know. Not interested in businesses like that. I'm interested in a business that actually makes real money and has no debt, and the future is we'll see. I will only buy GameStop. It's the only stock, in my opinion, that has real value in the market. Everything else is bullshit or overvalued. And if a stock looks undervalued, it's probably not. And if it is undervalued, it's probably a trash business. So there's a lot of factors. But let's get into this, I guess. All right, so they made 19 billion for the quarter, 66 billion for the year. That's down like 22 billion from last year. So Berkshire's earnings are actually going down. Their investment gains are up, but I think a lot of their businesses aren't doing that well. Yeah, their operating earnings are going down. So their investments are doing well, but I think a lot of their businesses aren't doing well. Well, I'm sure a lot of their businesses are doing good, but they're not doing as well as they used to. Like I said, Kai, if you can't see the future, we can't have a conversation about GameStop. If all you're focused on is right now, and we can't have a conversation about GameStop if you can't see the future. And also, all the information you're looking at is lagging. Like, every piece of information you're looking at on GameStop is 3 to 6 months behind the actual business. So not only are you looking at lagging information and making your opinion off lagging information, you're not looking into the future. And we just can't have a conversation if that's like how you're going to view it. I'm sorry, we can't. You got to have an open mind, and you got to be able to see the business for what it is, and you have to have analyzed thousands of other businesses like I have, so you can understand why I think the way I do. If you haven't analyzed thousands of other businesses and thousands of other stocks, we just can't have this conversation. Because your opinion is, my opinion's biased, of course, but my opinion has been formed by analyzing hundreds of other companies, possibly over 1,000 other companies, and there is nothing like GameStop. And also, when it comes to the valuation of the stock compared to the business, there's nothing like it. There's no other stock that's valued fairly on the market, unless it's a garbage business. So does anyone of the viewers here care about Berkshire? Can you talk more about GME or crypto or other more exciting stuff? Crypto's dog shit, so no, I can't. There's nothing to talk about crypto. Crypto's trash. And we talk about GameStop every single day, every single stream. In my country, I think GameStop doesn't even exist. They went out of business here. Not sure how I can see it in the future. I guess I need an old DeLorean. Now you just need to learn how to do fundamental analysis and research business, because they didn't go out of business. They got out of your country because doing business in your country is unprofitable. So again, you got to be able to do research, bro. You can't just have opinions that are not based on reality. I'm sorry, you just can't. Always got one of these people in here. Yeah. I mean, maybe he's actually trying to understand, but like, if you already have a bias and opinion and you're not able to like go and do research yourself and see the vision for yourself, I there's nothing I can say that's gonna help you get to that point. But it's not really for him. It's for other people. Maybe there's someone in here lurking that hears what I'm saying, and maybe they actually maybe they actually become successful investors because they realize that every other stock on the market's bullshit or overvalued. There's a lot of good businesses out there, but the stocks are overvalued, so it doesn't even matter. Like, if you're buying a good or mediocre business, but the stock's overvalued, you're just never going to profit. I'm open to GME, but don't know enough about it. I can only use the information available. Well, there's a lot of good information available, so I don't know. I don't know. A little biased, don't you think, to say that every stock in the world's overvalued except GME? No, it's not, because every stock is overvalued. Even GameStop's potentially a little bit overvalued, but at least it's like right there at fair value. Book value on GameStop's $13. Fair value is probably 20 to 22. So no, it's not bias. What other stock is fair value? Apple trades at they're sitting on 300 billion in assets and it's a $3 trillion market cap, overvalued. Like, every stock is overvalued except GameStop, literally. So it's not bias, it's reality. You seem to only think about book value. EPS is more important to me in the growth sector. You just you're not trying to make a 100% profit every single year. You have a different investment perspective, I suppose, and you're okay with making 10-20% profit potentially if you're lucky. I'm not. I'm trying to double my money every single year. So to buy something that's actually at fair value and could potentially grow 100% or more every single year, if from a fundamental perspective, you're not finding that anywhere. It's not possible. Just not possible. I've analyzed so many businesses. There's not a single one that's going to bring 100% of shareholder value in a year. And, GameStop's not going to do it for another like 2 or 3 years, but 2, 3 to 5 years down the road, if they have one year where they're making 3-4 billion, that's 40-50% of shareholder value added in a year. There's not a single company that's doing that. Not a single one. So you could say I'm biased, but I've done the research. My opinion isn't biased. My opinion is based off researching basically every fucking company there is. All right. Berkshire, then. I was hoping more people would come in the stream. That's kind of why I was waiting, but... And I mean, look at this part alone on Berkshire's balance sheet. Like, imagine a world where GameStop makes net earnings per average equivalent share $8.90 in one quarter. Like, imagine a future 5-10 years down the road where GameStop does that. You're essentially making 40-50% of shareholder value in a single quarter. $31 in a year. That would be over 100% in a year of shareholder value. That's you got to be able to see into the future. If you can't see in the future, investing's not It's going to be tough. It's going to be tough to be an investor. If all you're going to look at is right now, it's going to be tough. You have to be able to see the future. No, I don't hold Bitcoin. Crypto's trash, bro. Crypto has no value. Literally. Zero value. There's no value in crypto. What's up, AA Ron? How you doing, bro? How you doing, AA Ron? All right, so in the table above, investment gains, losses in 2025 include gains of 9.6 billion in the fourth quarter and 12.9 billion in the full year, and in 2024 include gains of 2.1 billion in the fourth quarter and losses of 38.1 billion in the full year due to changes during the fourth quarter, the full year, and unrealized gains that existed in our equity security investment holdings. Investment gains / losses in 2025 also include after-tax realized gains on sales of investments of 3.9 billion in the fourth quarter and 17.8 billion in the full year, and in 2024 include gains of 3.1 billion in the fourth quarter and 79.6 billion in the full year. This is their insurance. Oh no, this is just all their. So they made 10 billion for the court. Yeah, their earnings are going down. That's kind of wild, bro. I mean, it's not going down like drastically or anything like that. See, includes foreign currency exchange gains related to non-US dollar denominated, blah, blah, blah. On December 31st, there were 1.4 million Class A equivalent shares. Was an increase of 5 billion. Okay, so there's not much on that. There's not much on that. No, we're not talking about Iran. And war is relatively bullish for markets, so it's not even, I don't even want to have a conversation about that. I don't talk about fucking politic nonsense on this stream. And if you don't like what I'm talking about, then leave, bro. Then leave. Nobody wants to talk about fucking politics. Shit's fucking stupid. There's value in Gamestop power packs. Yeah, I saw the Buck collection. I saw it. What's up, Rosh? What's up, Rosh? You're like, yo, sorry, babe. Corey's on live. I gotta go. Berkshire earnings yawn. Well, it's not for you then. I stream basically every single day, so maybe you can come back when we're talking about something you want to talk about, but this is what we're doing today. I don't invest in Berkshire. I don't give a fuck about Berkshire, but this is how you research, Kai. This is research. This is how you become an educated investor, and you make opinions that are based on reality and not bias, like how you said earlier that you think my GameStop opinion is bias. It's not. It's based off thousands of hours of research, hundreds, potentially over 1,000 companies researched. This is how you become an educated investor, is by researching things you're not interested in, not focusing on dog shit crypto and a Iran strike that has nothing to do with the stock market. This is how you become educated, by researching boring shit. I know that's hard to understand, but that's reality, bro. This is how you get out of not buying trash investments like Duolingo. I mean, yeah. All right. So this is Greg Abel's shareholder letter. So to my fellow Berkshire shareholders, Warren Buffett is arguably the greatest investor of all time. Wait, I should do this as a stream clip, huh? Can I there we go. Look at that. Look at that. All right, let's make this a... So you spent thousands of hours researching over 1K companies and end up with just one investment, which is GME. That seems interesting. Well, there you go. You got it, buddy. You got it. I mean, there's other investments, don't get me wrong. I just think if you're looking out in a long enough time frame, 5, 10, 20, 30, 40 years, GameStop's the only one that's interesting, and it's the only stock that's fairly valued. There's a lot of other good investments. There's a lot of other good businesses that will do well, but I don't think they're going to outperform GameStop if you're looking on a long enough time frame. And also, like I was saying earlier, the protection of the downside risk protection is more what's interesting to me. I don't want to lose money. All right. So this is Greg Abel's first letter to shareholders from Berkshire. I don't know how I want to start this, actually. Hold up. Make this into a stream clip. Might as well, huh? Might as well. I just don't know how I want to start it. Yeah, I'm not buying fucking PayPal. PayPal's dog shit, bro. Again, you're not going to bring an investment here that I haven't already researched and already have an opinion on. I would never buy PayPal, even if I wasn't only buying GameStop. PayPal's trash, bro. PayPal's trash. So this is Greg Abel's shareholder letter to Berkshire. Blech. I can't make a good intro for this. This is Greg Abel's first shareholder letter to Berkshire Hathaway shareholders. To my fellow Berkshire shareholders, Warren Buffett is arguably the greatest investor of all time, with generations benefiting from his investment acumen. He has also been a remarkable CEO, executing his vision of building a great insurance business since the acquisition of National Indemnity in 1967, and deploying the float to make successful investments across major sectors of the economy. Concentrating in the U.S. To Warren's great frustration, this letter begins with these observations, yet we all know they are true. In the past, Warren has spoken about how he draws inspiration from Ted Williams, the Baseball Hall of Fame hitter, who divided the strike zone into 77 segments and tried to swing only at pitches in a much smaller, quote, happy zone, resulting in a .344 career batting average and a historic .406 season in 1941. Similar to discipline, patience, and judgment define Warren's investing, determining preferred pitches, waiting for them, then swinging decisively, but he is more than an investing guru. Warren built Berkshire into an enduring enterprise with his business partner Charlie Munger. They combined world-class capital allocation with vision and leadership to create a business fully equipped to transition from a founder-led to one well-positioned for the next 60 years and beyond. More than these achievements, what endures is how Berkshire treated its shareholders as true partners for 60 years. Warren has frequently expressed his respect and appreciation for Berkshire's long-term shareholders, who represent one of the most remarkable owner bases of any publicly owned business. He invested alongside us, wrote with candor about both mistakes and success, and welcomed us to Omaha each year for open, unfiltered discussion. His annual shareholder letters and direct interaction at Berkshire's annual shareholder meeting are the clearest expressions of Warren's and Berkshire's commitment to partnership with our shareholders. I mean, besides the annual shareholder letters and stuff, that sounds pretty similar to GameStop, huh? Pretty similar to GameStop. Weird, huh? We're fortunate to have Warren as Berkshire's chairman, in the office 5 days a week, and available to us as we underwrite insurance, operate our non-insurance business, and deploy capital including equity investments. Warren also continues as an owner of Berkshire, although his shares will all go to philanthropy over the 10 years or so following his passing. To invest in Berkshire has long been a vote of trust in our founder, a trust that now rests with Berkshire. Your capital is commingled with ours, but it does not belong to us. Our role is stewardship. That stewardship has shaped a culture and reinforced a set of values that are not the result of success, but the reason for it. I am honored by our board's decision to appoint me CEO of Berkshire, and humbled to succeed. Warren, as I write my first annual letter to you, Warren is obviously a very hard act to follow. Stepping into any leadership role begins with understanding the organization, why it exists, how its culture shapes its people, and what values guide its decisions. While you see similarities and differences between Warren, Charlie, and me, we share the view that Berkshire is shareholder-oriented to an unusual degree. My understanding of Berkshire in this way began in 1992, when I moved to Omaha to join Cal Energy. Then affiliated with Berkshire, Cal Energy was partly owned by Peter Kiewit's sons and chaired by Walter Scott Jr., who was also a Berkshire director. Walter had succeeded Peter Kiewit as the firm's CEO and set a standard for leadership that mattered greatly to me. My specific roles at Cal Energy matter little today. What matters is that it was an extraordinary period of personal development. I felt fortunate to live in Omaha, a city that represented a form of capitalism grounded in fundamentals and advanced by values, anchored in businesses built to last, across industries such as insurance, construction, railroads, manufacturing, and soon energy. I met Warren and Charlie after Cal Energy became Mid-American Energy Holdings and was acquired by Berkshire. I admired how they worked together to build an enterprise that reflected their beliefs about business and life. Those beliefs fostered Berkshire's culture and values that continue to guide the company today, enabling it to endure through market cycles, disruptions, and change. Our durability comes from knowing who we are and how we operate. That deep understanding of the role our culture and values play in our success is shared by our unique shareholders, our partners in this enterprise. Through my engagement with you at annual meetings, I recognize how you want us to succeed together and to do so in the right way. Berkshire's culture and values form the basis of our operating framework, which shapes the strategy we pursue and choices we make as we build Berkshire. As CEO, the framework governs how I lead every day. Our owner's time horizon extends beyond the tenure of any individual CEO. I will not be your CEO for the next 60 years, as simple arithmetic makes that, shall we say, an ambitious plan. However, 20 years from now, when I will have just a fraction of the tenure that Warren had, my intention is that you or your descendants will be proud that your company is even stronger. Culture and foundational values. Berkshire's success depends on our nearly 400,000 employees, their commitment to applying our culture and values across Berkshire's operating businesses, from See's Candy to Geico and everything in between, and in every circumstance is central to our progress. Our success also benefits from our board's leadership and ongoing alignment with our focus. Last month, I sent a letter to our employees to emphasize that Berkshire's culture and values remain unchanged and will continue into perpetuity. It is more important. I messed that up. I messed that up. Just call everything else than GME trash. Seems very narrow-minded. I've researched PayPal, bro. The stock's overvalued. The business is garbage. I'm not going to buy PayPal just because you come in here and say it's good. I don't trust your research. I trust my research. I've done the research. I've seen PayPal. I've seen PayPal go from a $500 stock to a $50 stock. It's garbage, bro. So you don't need to tell me anything about PayPal. I've already seen it. I know what fair value in business is. I know this game better than you. I'm sorry to say. I know this game better than you. So don't try to act like I don't. I know what I'm talking about, bro. There's a fucking reason why I only invest in GameStop. It's not because I'm narrow-minded. I'm actually more open-minded than anyone you know. So, you can think whatever you want, but I live this shit, bro. I live investing. I live researching business. Did you see 2 people fell in a sinkhole in Omaha? Yeah, I did. We watched that video on stream, actually. We watched that video on stream. No need to get aggressive. I'm not getting aggressive, but you don't know what you're talking about, bro. Don't say I'm narrow-minded. I know more about this than you. Here, I'll entertain you for another second. For one more second. Here, I'll show you why PayPal's trash, all right? I'll show you why PayPal's trash. All right. Went from $300 to $50. Okay, so it wasn't $500. So it went from what is that? 300 billion market cap to now 43 billion. All right. So it's sitting at 43 billion market cap. Here, this is how you research something in 2 seconds to see that it's trash. What was it again? 43 billion market cap, all right? Balance sheet. 80 billion in assets. Okay, it's actually not that bad. I still wouldn't buy it though. But 80 billion in assets, 60 billion in liabilities, only 20 billion in shareholder equity, so it's a little bit overvalued. It's not as overvalued as it used to be. And it's got decent net income, but it's still overvalued, and I'm not interested. They have way too much debt, way too many liabilities, and they don't grow shareholder value. Last year they had 20.4 billion in shareholder value. Or 2024 they had 20.4 billion in shareholder value. Last year they only had 20.2 billion. So they're losing shareholder value. They're losing shareholder value. That's not good. That's not good. But it's not as bad as I thought it was. I haven't looked at this in a long time, but it's because I'm not interested. I'm not interested in this, man. I'm just not. But it's not as bad as I thought it was going to be. But they have a lot of liabilities. That's, that's bad. I mean, it's not bad, but it can be. It can be. So, there you go. There you go. No, I would never buy it. I would never buy it. Too much risk. Too much risk. Oh, I said we watched that video on stream. We watched that video on stream. All right. Last month, I sent a letter to our employees to emphasize that Berkshire's culture and values remain unchanged and will continue in perpetuity. It is important to share with you in the full articulation of this statement that was provided to them, with additional observations about what they mean to me personally, based on my experience at Berkshire. While these values are listed individually, they are mutually reinforcing and inseparable. Berkshire is a unique conglomerate intentionally designed to allocate capital rationally and efficiently. Insurance is our core, and we also hold substantial investments in businesses across many other sectors. Our approach underpins our goal to be exceptional stewards of our shareholder capital, maximizing the growth in Berkshire's intrinsic value per share over the long term. We are committed to strengthening the great legacy built by Warren Buffett and his business partner Charlie Munger, ensuring it endures through our commitment to excellence. Our culture. Our culture begins with partnerships. Our culture begins with a partnership attitude. Our shareholders are our partners whose trust we have earned and must keep. Oh my gosh, I cannot read right now, dude. I cannot read right now. Our culture. Our culture begins with a partnership attitude. Our shareholders are our partners whose trust we have earned and must work to keep. Their interests are at the center of our decision making. This attitude goes well beyond Berkshire's corporate office in Omaha. It extends across our operating businesses, where employees embrace an ownership mindset, managing our shareholders' assets as if they were their own. We think in decades, act with discipline, and uphold our commitments. Stewardship is embedded in how we operate, reinforcing that our culture is a system for generating long-term performance, not just a set of beliefs. Charlie's comments on May 1st, 2021, that Greg will keep the culture will forever resonate with me. It was a reminder that our culture is our most treasured asset, a call to maintain what defines Berkshire, and a challenge to ensure our culture continues. When I led Berkshire Hathaway Energy, Berkshire's culture influenced how we operated. When capital was allocated or underlying risks were assessed, Warren's questions consistently cut to the heart of the issue. Beyond that, we were entrusted with real autonomy to run the business, always focusing on our customers and taking a long-term view. That owner's mindset is expected from every Berkshire leader. Our foundational values. The foundational values that follow are statements of principle that we embrace fully and strive every day to achieve. Decentralized model. We seek the best managers to run our operating businesses, who in turn lead talented teams. We operate a decentralized model with autonomy grounded in deserved trust. We minimize bureaucracy to provide our managers the independence to focus relentlessly on their business. In return, we expect accountability and integrity in performance. This autonomy attracts exceptional people to Berkshire. As I transitioned to vice chairman, non-insurance operations in 2018, the leaders of those operating businesses shared a similar question. Will the decentralized model and their responsibilities change? I assured them that I had lived the culture of autonomy paired with accountability and seen the results. Decisions are made faster, with better knowledge and greater conviction, when they are made by those who are closest to the business and have accountability for its outcomes. This will not change. Our CEOs will never have to navigate layers of bureaucracy or have short-term earnings expectations dictated to them, leading to long-term value destruction. Our decentralized approach is a competitive advantage, attracting managers who thrive on autonomy and deliver on accountability. Berkshire must have leaders that reflect its principles and not principles that fit individuals. Integrity. We uphold Berkshire's reputation for integrity, as demonstrated by alignment between how we think, what we say, and what we do. We make decisions that uphold our culture, communicate with candor and transparency, and deliver on our commitments. The result is a reputation that is earned and not claimed through cumulative principled conduct. Every action reflects a deliberate effort to deepen the trust placed in Berkshire. For over 25 years, at each shareholder meeting, we played a clip from Warren's 1991 Solomon Brothers congressional testimony, "Lose money for the firm, and I will be understanding. Lose a shred of reputation for the firm, and I will be ruthless." Our commitment to integrity has always been steadfast and uncompromising. We know integrity is not quality you admire on a shelf. It is an active quality that must be earned, re-earned, and maintained daily. We'll encounter business successes and setbacks. When we fail, we will say so. Doing the right things also means rectifying our errors. A great example of both is BNSF's resolution in 2025 of a long-standing dispute with the Swinomish Indian tribal community over crude oil shipments across tribal land. The BNSF decisions that sparked the dispute were made long ago, but the current BNSF leadership built a partnership rooted in communication, understanding, and respect. BNSF acknowledged its past mistakes and apologized, paving the way for mutually beneficial agreements that allow it to meet customer needs while operating safely on tribal land. Across our operating businesses, we make choices every day about how we conduct ourselves. We have hundreds of thousands of employees who are good people and act with integrity and do the right thing, but in any large organization, a small minority will fail to meet the standards. We will not tolerate such behavior. When it occurs, we will act decisively and ruthlessly to address it. Protecting our integrity and reputation is a never-ending journey. You can rest assured that we will remain relentless in this effort. Financial strength. We maintain a fortress-like balance sheet, ensuring Berkshire's foundation is never compromised. We preserve this financial strength by using debt sparingly and prudently. Our substantial liquidity enables us to meet obligations even under the most adverse conditions and to respond swiftly when opportunities arise. We are committed to maintaining exceptional financial strength. Our balance sheet is a strategic asset to be deployed at the right time. It allows us to act decisively, invest when others are tentative or fearful, and stand firm when financial storms roll through. We uphold Berkshire's financial resilience and independence by holding limited levels of debt. We will remain an asset, not a risk, to America and the global financial system. Man, it sounds so similar to GameStop, it's actually insane. Our cash and U.S. Treasury holdings now exceed $370 billion. While some of this capital is required to support our insurance operations and protect Berkshire against extreme scenarios, it also constitutes our dry powder. There will undoubtedly be incremental opportunities to deploy our owners' capital without compromising Berkshire's resilience. My role is to ensure our liquidity levels and capital deployment remain intentional and deliberate. We will always aim for ownership of productive business over the U.S. Treasuries. Capital discipline. We deploy our shareholders' capital to opportunities that generate rewards commensurate with their risk. When we expand existing operations, acquire new operating businesses, invest in equity securities, and repurchase Berkshire stock, we evaluate each opportunity based on its potential to grow Berkshire's intrinsic value per share over a time horizon measured in perpetuity. Holy. Berkshire's capital allocation principles and strategy guides us in identifying opportunities. Invest in businesses that we thoroughly understand, with durable advantages and long-term economic prospects. Partner with high-integrity leaders who understand their customers and act like owners. Avoid businesses that undermine the fabric of society or could jeopardize Berkshire's reputation. Act quickly and concentrate our capital in a few high-conviction ideas. And maintain discipline and let compounding unfold. These criteria enable us to effectively and efficiently evaluate opportunities that come our way. Despite our substantial size, we take pride in a nimble culture where big investment opportunities can be confidentially shared with us, with a prompt response assured, and if we like it, no financing contingency attached. We quickly say no to those that do not align with our principles and pursue those that do, knowing there will be many more of the former than the latter. Many times in Berkshire's history, some observers have suggested our substantial cash position signals a retreat from investing. It does not. We continue to evaluate many opportunities and will remain patient and disciplined in pursuing the right ones for the benefit of our owners. In 2025, our approach resulted in Berkshire announcing the acquisition of two very different businesses, OxyChem and Bell Laboratories. OxyChem is a well-run industrial chemical business we first encountered through our investment in Occidental. The chlorine and caustic soda it produces serve essential markets, led by construction and core industrial uses. Management prioritizes efficient execution over volume, supported by an integrated asset base and access to low-cost raw materials. For Berkshire, this translates into cash flows from a compelling addition to our operating businesses. Last year, Warren received a letter from Steve Levy, Bell Laboratories CEO, asking that we look at the family-owned business he manages for the daughters of founder Malcolm Stack. Steve's letter was perfect. Bell Laboratories meets a persistent need, rodent control. In Steve's words, it possesses high operating margins, very good historical growth, and future growth potential, easy to understand and always needed, and a strong management team. In our words, a business with durable advantages and long-term economic prospects run by excellent managers. We only wish it had been 10 times bigger. These investments now join Berkshire's strong set of operating businesses. Some of them require little incremental investment and return excess cash to Berkshire. Others present compelling investment opportunities that will compound over time. Share repurchases are another important capital allocation option. We will buy back Berkshire shares when they trade below our estimate of intrinsic value, conservatively determined, ensuring that repurchases enhance per share value for continuing owners. We may also purchase large blocks of shares directly from major holders when the opportunity presents itself. These purchases allow shareholders to own an incrementally larger piece of Berkshire's businesses without deploying any additional capital of their own. That's awesome. Our approach to cash dividends continues to be that Berkshire will not pay dividends so long as more than $1 of market value for shareholders is reasonably likely to be created by each dollar of retained earnings. On an annual basis, the board reviews our policy. Dividends are also whack because you got to pay taxes on the dividends. So, as a shareholder, dividends aren't really valuable in my opinion. Our capital discipline guides us. Whether we seek to purchase an entire business, a portion of equity in a publicly traded company, or our own shares, we maintain this approach regardless of the size of our cash and U.S. Treasury holdings. We will assess value carefully, act patiently, and hold for long-term, preferably forever. Risk management. We identify risks and strive to manage the level of risks across our organization. Our approach is decentralized, suited to each operating business's scale and complexity. We focus on risks that could threaten Berkshire's reputation, financial strength, or ability to realize opportunities for the long term. Risk management is central to Berkshire. The CEO is responsible for serving the CRO, Chief Risk Officer. There is no more important duty. An important part of fulfilling that responsibility is having the best on our team. When it comes to risk, Ajit wrote the playbook. His rigor is managing the pricing risks set the standard in insurance. Any contract can be subject to legal challenge, and new coverages are particularly dangerous. We often set a price today for a cost that may not be known for many years. Pricing insurance risk correctly is essential, and we'll walk away when the price is wrong. This approach is core to our insurance business, and Ajit is simply peerless at doing it. As a result, our insurance operations are a global powerhouse, able to accept risks others cannot, and pay claims without hesitation. Our unmatched financial strength allows us to retain underwriting risk and preserve the full economics for our owners, rather than dilute it through for the purchase of reinsurance. Of course, understanding and managing risk is also essential for our non-insurance businesses. Each must thoroughly assess its specific risks and plan for new risks before pursuing new or incremental opportunities. Across all our businesses, our responsibility is to understand the risks and actively manage them. Operational excellence. We pursue operational excellence across our operating businesses. Our employees continuously strive to exceed customer expectations, improve efficiency to better compete and prepare for challenges to our operating models, and reinvest prudently in their operations. We recognize that performance fluctuates year to year, so we assess a business's success not by short-term results, but by its ability over the long term to maintain and strengthen its competitive position and improve its economic prospects. Operational excellence at Berkshire is not a program. It is the result of disciplined decision-making across our businesses. That work starts with safety and carries through to how we serve customers, make products, and compete every day. In February 2025, Precision Cast Parts' response to a major fire at its Jenkintown, Pennsylvania facility showed Berkshire at its best. All employees on site were evacuated safely. The team then worked closely with first responders, providing site layouts and identifying potential hazards. In the aftermath, Precision Cast Parts supported the local volunteer fire department, assisted the city, and conducted extensive environmental testing that confirmed the area was safe. At the same time, the fire created a significant operational challenge. The facility produced more than 700 parts that were sole sourced and critical to major aerospace customers. Mark Donegan, Precision Cast Parts CEO, and his team quickly redistributed production across U.S. and international sites, doing so without compromising safety, quality, or delivery standards. No customer experienced a production line stoppage. The episode reflected our model at work: decentralized leadership, clear accountability, and exceptional execution under pressure. The daily pursuit of excellence must be never-ending. By focusing on customers' efficiency and continuous improvement, we create value over the long term. Taking together, the foundational values listed above build Berkshire and equip us to succeed in the decades ahead. While we have to set them out explicitly this year, we'll publish them as an attachment to the future letters, with each letter discussing how we practice those values across Berkshire. Their impact is also evident in the operating performance of our businesses today. Berkshire's performance. Berkshire delivered operating earnings of $44.5 billion in 2025, below $47.4 billion in 2024, and above the $37.5 billion we have averaged over the past 5 years, a result that underscored the durability of our operating businesses, while also reflecting the fact that we have opportunities for further improvement. Before diving into details, it is worth reiterating a Berkshire belief: our GAAP net earnings, with its sometimes large annual swings from realized and unrealized investment gains and losses, must be assessed with caution. These gains and losses matter over the long run, but when evaluating Berkshire's annual business performance, we believe operating earnings remain the best measure. Equally important is the cash our business generates. In 2025, Berkshire produced $46 billion of net cash flows from operating activities, compared to a 5-year average of more than $40 billion, underscoring our ability to invest in opportunities across our businesses. Insurance operations. In 2025, Berkshire's insurance operations accomplished their fundamental goals: grow underwriting profits and float in a disciplined manner. We own an extraordinary group of insurance businesses, each managed with a long-term orientation. Their performance reflected both their inherent strengths and an industry that, after several years of needed adjustments to pricing and policy terms, in 2025 began to experience a deceleration or reversal of these trends, particularly in the latter half of the year. This likely means we will write less property and casualty business for a period of time. Although the year began with the significant wildfire-related losses in Los Angeles, the Atlantic hurricane season was unusually benign. For the first time in a decade, no hurricane made landfall in the U.S., our largest region of global exposure for our primary insurance and reassurance businesses. A reminder that nature controls the winds, not Warren, and certainly not me. We produced a combined ratio of 87.1% across our property and casualty businesses in 2025, Comparing favorably with our 5-year average of 90.7%, 10-year average of 93%, and 20-year average of 92.2%, an exceptional underwriting result for an insurer of our scale. Our retroactive reinsurance business, which does not receive regular premiums, is excluded from these figures. No discussion for our insurance businesses would be complete without again acknowledging and appreciating Ajit. For nearly 4 decades, his judgment and discipline have shaped our ability to underwrite large and complex risks with care and precision. The organization and team he built understand both the limits and the opportunities inherently in a very large risks. And his example continues to guide our team. Their steadiness benefits us all. Geico. Geico has been a significant contributor to the group's lower combined ratio. Over the past few years, Geico has improved its cost structure, strengthened its underwriting discipline, and enhanced its ability to segment customers and the related pricing of risk. Industry-wide rate increases from the end of 22 through 24 continue to positively impact performance in 2025. While these increases varied by product and jurisdiction, the pricing environment remained firm, and Geico benefited accordingly. Geico's broad rate increases in recent years have restored margins, but come at the cost of lower retention. Competitors' rate reductions may extend that pressure in 2026. The Geico team remains focused on pricing risk correctly for both existing and new customers. Restoring retention while maintaining underwriting discipline will take time. Alongside retaining its customer base with a more nuanced pricing strategy, Geico is investing in technology to improve efficiency and service while preserving its position as the industry's low-cost provider. Primary Group. Across other primary property and casualty businesses, demand entering 2025 was solid, and pricing in most commercial insurance business segments was adequate or improving. As the year progressed, additional capital entered the market, resulting in lower pricing or decelerating rate increases in several important lines. We have always prioritized underwriting discipline over the volume, and as pricing became less attractive, our premium growth plateaued. We expect these primary insurance businesses to face continued headwinds in 2026 and potentially beyond. Reinsurance Group. Our reinsurance operations face similar dynamics. The reinsurance sector has attracted significant increases in available capital from both the traditional and alternative markets, which together with a more benign reinsured catastrophe loss burden in 2025 in most major regions has led to significant price declines in property reinsurance. In most casualty reinsurance segments, claims inflation continued to outpace pricing. As long as these phases of cycle endure, we expect to write less reinsurance premium. Our insurance team will remain patient because of Berkshire's structural strengths. One, we have significant capital, enabling us to underwrite large and unusual risks. Two, we give our insurance managers autonomy to run their businesses without quarterly earnings targets or growth mandates that might otherwise distort their underwriting judgment. 3, we insist on underwriting discipline as the most important ingredient in insurance success. 4, we focus on the long term, resisting temporary industry enthusiasms and exuberances. The environment ahead will reward insurers whose focus remains on growing underwriting profit sustainability, not volume, customer trust and loyalty, not temporary spikes in market share, and long-term resilience, not short-lived opportunism. At year-end, our insurance float, the capital we hold to pay future losses and in the meantime invest for Berkshire's benefit, stood at $176 billion. That amount increased from $171 billion at the end of 2024 and from $88 billion at the end of 2015. Our insurance business's ability to declare ordinary dividends to Berkshire is restricted by insurance statutes and regulations, permitting up to $31 billion during 2025 without prior regulatory approval. The insurance businesses ultimately returned $29 billion to Berkshire in the year, underscoring the continued strength of their capital base. Non-insurance operations. Our non-insurance group is composed of strong businesses operating within the railroad, utilities, and energy, manufacturing, service, and retailing industries. It also includes Pilot and McLean. Berkshire's approach with its 51 non-insurance operating businesses is markedly different from most conglomerates. There are no layers of management and no allocated goals or targets set by Berkshire. Each business is accountable to its CEO, who is expected to pursue operational excellence relentlessly and close performance gaps. Capital allocation decisions for these businesses ultimately reside with me as Berkshire's CEO and are based on each business's opportunities and related risks. Most operate with no debt and will remain that way. Across these businesses, we have made progress in the fundamentals that drive long-term value, but also have a clear understanding of where we need to improve performance. Regardless of our industry, our expectations are the same: managers who think like owners and rigorous execution, measured by results, not intentions. We are fortunate to have Adam Johnson now serving as president of our consumer products, service, and retailing businesses. Adam, who has lived the Berkshire culture for nearly 30 years, 10 as CEO of NetJets, is now responsible for a group of consisting 32 companies. Adam and his team at NetJets think like owners and earned their reputation for operational excellence over the past decade. Their work transformed NetJets from a challenged business model into a successful enterprise that delivers value for Berkshire shareholders. That same approach, accountability, and a focus on avoiding complacency will guide how he works with the CEOs across his portfolio. BNSF. As one of the 6 major freight railroads in North America, BNSF is a key part of the transportation backbone of the U.S. economy. Berkshire acquired this iconic business in 2010 with an equity value of $34.5 billion. In 2025, BNSF produced $8.1 billion in net operating cash flows and returned $4.4 billion of that cash to Berkshire through dividends. For context, its average annual dividends over the past 5 years was $4.1 billion. Safe operations, reliable service, and a competitive cost structure ultimately determines a railroad's success and accordingly how we assess management's performance. BNSF has focused on improving each of these. Safety remains the top priority, and BNSF has been the industry leader for the past decade. In 2025, shipments spent less time idling at terminals and moved through the network faster than in nearly any year in the company's history. These gains matter, but they are not enough. More progress is needed to translate operational improvements into stronger financial results. We view operating margin, the inverse of industry's operating ratio, as the best measure of performance. In 2025, BNSF's operating margin improved to 34.5% from 32% in 2024. It remained only modestly above its 5-year average. The gap to the industry's best remained too wide, and closing it will require continued improvements in efficiency and service. Each 1 percentage point improvement in operating margin generates approximately $230 million of incremental operating cash flow for our owners. The team recognizes the significance of this opportunity, and we will be disappointed if we do not deliver a substantial improvement over the next few years. Alongside BNSF's own improvements, there is also potential consolidation in the rail industry with the proposed Union Pacific-Norfolk Southern merger. Berkshire has been clear that it is not interested in acquiring one of the other Class 1 railroads, since the current economics would not work in our shareholders' favor. BNSF's focus on the proposed merger has been to ensure BNSF can continue to offer customers a compelling value proposition including full and competitive access to Eastern rail markets. BHE. BHE's objective is straightforward: to deliver affordable and reliable energy service for its customers. That responsibility has grown as the industry enters a significant investment cycle, driven by rising electricity demand from artificial intelligence computing, and by increasing wildfire risk, particularly in the western U.S. Growth is welcome, but it will not come at the expense of affordability or reliability for households, small businesses, and industrial users. BHE is proud that it continues to offer meaningful value to customers in the markets it serves, averaging 24% below the national retail electric rate level, with all its markets priced at least in the double-digit range beneath that benchmark. Infrastructure built for hyperscalers and data centers must be paid for by those customers and reflect the risks tied to step changes in long-term demand. BHE will pursue this incremental growth and invest our shareholders' capital only when those risks and rewards are appropriately balanced. On wildfire risk, BHE has taken a leadership role, working with regulators, public officials, and the communities it serves. Its mitigation programs are among the most comprehensive in the industry. When a BHE utility is responsible for a wildfire, it has acknowledged that responsibility, including PacifiCorp's settlements related primarily to the 2020 Labor Day fires. At the same time, PacifiCorp is not an insurer of last resort and should not be treated as a deep pocket. Where responsibility does not exist, it will continue to seek judicial relief. Accountability, paired with principled opposition to unwarranted liability, is essential to preserving the regulatory compact that governs utilities. BHE is rebalancing as the team positions it to move forward. In 2025, BHE produced $8.4 billion in net cash flows from operating activities, consistent with its 5-year average. Even as it absorbs these challenges, our willingness to invest capital depends on our continued functioning of the regulatory compact through which utilities earn a reasonable return on invested capital. Near-term opportunities are significant, and BHE will pursue them selectively. Manufacturing, industrial products. The macro environment. Okay, I need a minute, bro. There's a lot of reading. Holy shit. Holy shit. Holy shit. Oh, that's a lot of reading. How close are we to being to the end? Oh my god. Okay, we're pretty close, actually. We're pretty close. What's up, Ruben? How you doing, bro? Hope you're having a good weekend so far. Where was I? I think here. A lot of reading, a lot of reading. No, so this is just the shareholder letter, basically, added in with some numbers, potentially. I'm gonna read, bro. Don't tell me what to do. It's my stream, my guy. If you don't like what I'm doing, leave. I'm gonna read the whole thing, and if you don't like it, I don't know why you're here. I do what I want on this stream, not what you want me to do. This is my stream, not yours. You're just a spectator, my friend. If you don't like it, then leave. I don't even stream on the weekends most of the time. I'm not going to read all this, though. There's a lot here. Yeah, I don't know if I'll go through that, but we'll see. I will. I will. I'm about to read it again. Okay. Manufacturing industrial products. The macro environment in 2025 for industrial product businesses was challenging, yet the business delivered earnings results that demonstrated underlying resilience. Operational execution was strong across the group, and specifically at Precision Cast Parts, Marmon, IMC, and Lubrizol, which positions all of them well to pursue incremental opportunities. The Lubrizol team, led by Rebecca Liebert, was integral to the acquisition of OxyChem and its planned integration as a standalone operating business with Berkshire. Rebecca has assumed responsibility for OxyChem, in addition to her role as CEO of Lubrizol. Working in partnership with OxyChem CEO Wade Ailman and his leadership team, our largest industrial manufacturing business, Precision Cast Parts, spent most of the past decade navigating a difficult period for the aerospace industry. Aircraft production slowed materially, volumes declined, and a series of disruptions, most notably the pandemic, when air travel effectively stopped, put sustained pressure on earnings. The Precision Cast Part team has now worked through the most challenging part of that period. Air travel has recovered, aircraft orders have resumed, and demand for the company's components has normalized and is growing. The business has remained disciplined throughout, with management focused on translating a healthier industry backdrop into margins that better reflect its long-term potential. In 2025, Precision Cast Parts generated $2.4 billion of net cash flows from its operating activities, compared to a $0.9 billion in 2021 and 22, and $1.7 billion in 2015, the last full fiscal year before our acquisition. Manufacturing building products. Our building products businesses span the U.S. housing commercial building landscape, from the homes Clayton builds to the materials and finishes our other companies supply. As in any market, end consumer preferences can evolve, and our businesses must adapt accordingly to meet those challenges, or to meet those changing demands. Shaw has navigated a challenging period as consumers moved away from soft surface flooring, carpets, and some of its difficulties were self-inflicted. As it expanded hard surface production, execution slipped, affecting quality and service. Shaw is now rebuilding its manufacturing organization and restoring the operational discipline needed to regain customer confidence. Clayton leads the group in size. Its business model, centered on efficient manufacturing and construction of well-built homes, supported by integrated financing, has proven resilient through short-term shifts in the broader housing market. This approach enables Clayton to meet the ongoing need for quality, affordable housing nationwide. While activity in this building products sector varies from year to year with broader construction trends, the long-term needs for housing and commercial buildings remain strong, positioning the group, which also includes Johns Manville and Mytech, well for the future. This durable demand underpins those operations, which are distinguished by disciplined and knowledgeable management, a strong focus on customers, and well-established operating models. Manufacturing, consumer products, and service and retailing. As highlighted earlier in the letter, Adam is president of Berkshire's consumer products, service, and retailing businesses. These businesses performed well overall in 2025, recognizing certain consumer segments faced a very challenging environment. NetJets is the largest business in our service group. NetJets maintains a relentless focus on safety and exceptional service to reinforce its position as a premium offering. That foundation has enabled NetJets to attract many customers, and today it operates nearly 1,100 aircrafts in over 150 countries around the world. It is a prized asset in a very tough industry. Pilot. Pilot continues to strengthen its operations as the largest operator of travel centers in North America. It competes on location, service, and reliability. Management is focused on execution at the store level, improving customer experience for both professional drivers and everyday travelers, investing in store upgrades, food offerings, and customer loyalty. Since 2023, Pilot has increased capital spending to modernize facilities and expand its electric vehicle charging network. These efforts are reflected in Pilot's Pro Preference Score, a third-party study of how often professional drivers choose Pilot over travel center competitors, which rose from 27% in 2022 to 35% in 2025, placing the business second in the industry. We should be number one, and we will not be pleased until that standard is achieved. We first invested in Pilot in 2017. However, our ability to manage it was contractually delayed until 2023. That mistake will not happen again. I don't even know Berkshire owned Pilot. Kind of interesting. The underlying economics of the business are reflected in the cash generation. In 2025, Pilot delivered $1.7 billion of net cash flow from operating activities, an improvement from 2024. As operations continue to strengthen and capital needs normalize, we expect more cash to be returned to Berkshire. Equity investments. We apply the same fundamental value of capital discipline to Berkshire's portfolio of equity securities as we do to our operating businesses. A large portion of our portfolio is concentrated in a small number of American companies such as Apple, American Express, Coca-Cola, and Moody's, businesses we understand well and have high regard for their leaders and expect will compound over decades. This concentrated approach will continue with limited activity in these holdings, though we may significantly adjust a holding if we see fundamental changes in its long-term economic prospects. They've been selling Apple, though, so what do they mean compound over decades? Interesting. The same criteria applies to our investments in Japan, which we view as comparable to our major U.S. holdings in importance and long-term value creation opportunity. Berkshire has borrowed in Japan an amount roughly equivalent to the yen invested cost basis at an average cost of 1.2%, with a weighted average life of approximately 5.75 years. Taking these positions together at year-end, they totaled $194 billion in market value, representing nearly two-thirds of our $297.8 billion equity securities portfolio, providing combined dividends of $2.5 billion and yielding 10% on their original cost basis of $24.5 billion. Separately, we have meaningful positions in a small number of other companies where our capital allocation has been more dynamic in recent periods as relative values and opportunities change. In certain cases, the underlying business characteristics are such that, over time, these investments may become part of our core holdings. We also hold equity method investments, principally Kraft Heinz and Occidental. Our investment in Kraft Heinz has been disappointing, even after considering the preferred equity component in our original Heinz investment. Our return has been well short of adequate. At Berkshire, equity investments are fundamental to our capital allocation activities. Responsibility ultimately resides with me as CEO. Ted Weschler manages about 6% of our investments, including a portion of the portfolio formerly overseen by Todd Combs. Ted's impact extends beyond these investments, as he continues to play a broader role in assessing significant opportunities, providing valuable input on our businesses, and supporting Berkshire in various other ways. Berkshire's foundation is second to none. We have a remarkable operating framework, our culture and values, that shapes our strategy and guides how we lead, along with remarkable shareholders. Insurance will continue to be our core. While its performance will ebb and flow with capital conditions in the industry, perhaps dramatically, that heart of Berkshire will only grow stronger over time, reflecting the structural advantage that defines it. Our non-insurance operations generate substantial operating earnings and reoccurring cash flows. A substantial focus on operational excellence will strengthen this group of businesses, positioning it to deliver even greater long-term value. Our investment portfolio, specifically our equity investments, will evolve and grow as opportunities arise. This portfolio is an integral extension of our insurance operations and capital base. We will effectively and efficiently return capital to our owners through share repurchases when the value proposition is compelling. At Berkshire's scale, the math of compounding works against us, a reality long understood and best acknowledged plainly. Our opportunity is improvement in per share value over the long term, even when progress comes in smaller increments, with a constant focus on managing downside risk for our owners. The value we create as Berkshire stems from the judgment and leadership exercised every day across our operating businesses. We as shareholders are fortunate to have a board that clearly understands and supports Berkshire, including our culture and values, and whose diverse skills, experience, and perspectives strengthen its stewardship of the company. Warren and Charlie built the framework for that alignment, and we continue to draw on Warren's exceptional judgment as chairman. In December, we announced that our CFO, Mark Hamburg, will be retiring from Berkshire effective June 1st, 2027, and will transition his CFO responsibilities a year prior on June 1st, 2026. Chuck Chang will have an enormous pair of shoes to fill as his successor. Mark will help Chuck settle into his new role before fully enjoying his well-deserved retirement. Mark has been a treasured partner to me, and as Warren has noted, Mark has been indispensable to Berkshire and to me. His integrity and judgment are priceless. He has done more for this company than many of our shareholders will ever know. I strongly echo Warren's comments. To further strengthen our management capabilities at the corporate office, we recently welcomed Michael Sullivan as Berkshire's first general counsel, where he will provide legal support while maintaining our culture. A central part of our partnership with our owners is to continue maintaining clean, candid communication with you. Berkshire will always communicate with all shareholders at the same time and through the same channels to give each of you the necessary information to assess Berkshire's performance. We concentrate on quality, not frequency. If a significant issue arises, you will hear from me, but it will not be through quarterly commentary given our long-term horizon. The next time we gather as owners will be in Omaha on May 2nd, 2026 for the annual meeting, our Owners' Day, or what other companies might call an Investor Day. The format you know well will guide the day, centered on open communication and direct engagement, with your questions answered in the same unscripted manner during sessions moderated by Becky Quick. We also look forward to owners getting to know, over time, more of the Berkshire team. This year's program will include a CEO's update on Berkshire and 2 Q&A sessions, one with Ajit and me, and a second featuring Katie Farmer, BNSF, Adam Johnson, NetJets and the President of Consumer Products, Service and Retailing, and me, where Katie and Adam will discuss the challenges and opportunities they see in their respective businesses. In that way, we'll be able to cover Berkshire's insurance and non-insurance operations. While each session has a natural focus based on who is on stage with me, shareholders may ask me any question at any time. Further details are included in this annual report. Our board, the CEOs, and managers at Berkshire, and I look forward to welcoming you to Omaha and to our continued partnership. Central to Berkshire's extraordinary success is the relationship we maintain with you, our owners. I am honored by the responsibility of continuing to build our company and our partnership in the years ahead. We move forward with great intent and purpose. Gregory E. Abel, CEO, February 28th, 2026. Wow. And they got Berkshire's performance versus the S&P here. That's crazy. That's crazy. Every single year. Holy shit. Overall gain 1964 to 2025. 6.1 million%. The S&P's done 46,000%. 6.1 million% gain. Holy shit. And you wonder why I'm so bullish on GameStop. And I love the S&P. The S&P is a great investment, but you wonder why I only put money in GameStop. 6.1 million fucking %. Good Lord. That's insane. 6.1 million%. You know what that is? Can we just do some can we do a little math here? GameStop's at what? 10 billion market cap? 10 billion times 6.1 million. I don't know if GameStop's gonna do this, but what if it even does like 1 million or 2 million%? 610. I don't know if I did that right. Let's just go off of the share price today. $20 times 6.1 million%. $1.2 million per share. Huh. Weird. Imagine. Berkshire did that in 60 years. I mean, I'll be dead. I'll be dead by the time, if this happens with GameStop, I'll be dead. But still. 6.1 million%, dude. That's ridiculous, bro. That is absolutely ridiculous. That is absolutely ridiculous. Oh, man. That's crazy. That's crazy, bro. What's up, Varley? You're good at reading. Thanks, Kraj. Appreciate you, man. Berkshire needs to 50% drop for people to even take notice. Well, that's never going to happen. That's literally never going to happen. It could drop like 10, 20%, but 50? Probably not. I don't even think that would happen in a market crash. What's up, Michael Anthony? 6.1 million%. Like, can we just, can we just do a little bit more math? What if they only do like 1 million%? What if they only do 1 million% in like 50 years? That's still $200,000 a share. I mean, even if you're holding 1,000 shares, you're a multi-millionaire. So, what if they only do 100,000%? Can we dilute it even more? What if they only do 100,000%? 20,000 per share? I mean, even if you have 1,000 shares, you're a multi-millionaire. Ah. Oh man, chat. Oh man, 6.1 million over 60 years. Maybe that won't happen. But what if it does? Yeah, I'm done reading. That was a lot. I don't think I'm going to read this. I mean, most of this is what we already read. I don't know how much additional information is here. 6.1, right? Compounded annual gain 20%. Like, that's crazy, bro. Can we talk about compounding for a minute? Can we talk about compounding for a minute? 20% a year. 20% a year. So 20 times 20%. That's 4. 24 times 20%. That's 5. 29 times 20%. Whoops. That's 6. So that's 3 years. That's 3 years. You've already got like 60%-ish, 70%-ish, I think. So 35 times 20%. That's 7. 42 times 20%. That's 8.4. I think you get the idea. 50 times 20%. That's 60 or 10. 60 times 20%. 72 times 20%. And that's a low estimate. That's an average. There's going to be years where it goes up more. There might be bad years. Who knows? There could be bad years. Imagine being my neighbor, seeing a guy through the window doing the dishes, laughing his ass off, screaming 6.1 million in German. Bro, I just laughed so hard. That's funny, bro. Math class, I think I preferred the reading. Oh, math's important. Seinfeld, the episode where George presents their show about nothing and they should actually read during the show. I don't think I know that. I don't think I know about that. Seinfeld's funny, though. I think Seinfeld's funny. Damn, they go through every individual business. Crazy, man. Every individual business, they have a little segment of just talking about it. Like, you could dive so deep into this, man. You could dive so deep into this. They own Fruit of Loom. They own Duracell. I didn't know that. God, Berkshire owns everything, huh? They own McLean. I didn't know that. God, Berkshire owns everything, bro. Dairy Queen, I knew that. They own everything. Wait, they own RC Willie? I'm just kidding. They don't own everything, but they own a lot of things that I did not know they owned. This is all their risks. I can't. That's too much, bro. That's too much. That's too much. That is too much, bro. Nah, I'm not reading the past 2 quarters. I'm not too worried about the past. The past is why so many people think GameStop's a bad investment. So looking at the past isn't a good indicator of the future in a lot of cases. It can be, sometimes. Not in investing, though, I don't think. Oh. I want you to explain how GME will make more money in the future. I already told you, and I'm not repeating myself. And it's still yet to be, we'll see. Time will tell. Said Bitcoin was dog shit, but they own digital assets like Bitcoin. I don't care. I still think Bitcoin is dog shit. I'm not happy that they bought Bitcoin. I think it's a stupid investment, but doesn't mean it can't not work out. It could go back up, but it's still a trash investment. Ask anyone who's been here for long enough. When they bought Bitcoin, I was gonna sell. But since they only bought a little bit of it, I didn't really care. But it's still a trash investment. I almost sold GameStop because of that investment. But it's a small little portion. Is gold and silver a good investment? Not anymore. It was about 6 months ago. And the prior 10 years before that. But not anymore. And also gold and silver have no value. They don't produce anything. So it's not a good investment in my opinion. It doesn't produce anything. It's basically just crypto. They don't produce anything. Crypto, Pokemon, gold, silver, basically any collectible thing, it doesn't produce anything. So in my opinion, it's not a good investment. Just because a price goes up doesn't mean it's a good investment. I've seen a lot of prices go up. Buying things that don't produce anything, I don't think that's a good investment. It's quite a lot. Not really. They have what, over 11 billion in assets? 5k Bitcoin's nothing. 5k Bitcoin's nothing. I don't like real estate either. But real estate has value. You need somewhere to live. And at least you can, do Airbnb, you can rent. And if you think like gold, silver, and crypto is a good investment, when you buy a house, you're buying brick, you're buying concrete, you're buying steel. So if you think crypto and gold and silver and stuff are a good investment, real estate's even better. Because at least it has a use case. What the fuck do you use a lot of that other stuff for? I mean, when you buy a house, you're getting copper. You got copper pipes. Unless you have PEX or whatever. You're getting copper pipes when you buy a house. You're getting all the copper wire from the electricity. So, out of any of those commodity type investments, real estate's the best one because you get commodities and real estate actually has a use case. You get property. I'm not a big fan of real estate. I think in the next 5-10 years, it's going to be extremely expensive to own a house, but it's a better investment than all that other stuff. And you can get cheap loans from your real estate. I could go refi my house right now for like and get like a 5% ish interest rate. Like you can't really do that with anything else. So real estate has a lot of value. But it still doesn't produce anything. I'll just build a house of silver, loophole located. I don't, maybe, I don't know. That'd be a shiny house. That'd be a shiny house. Nah, don't be bringing that doomer shit here, bro. Don't be bringing that doomer shit here. When your grandparents were buying real estate, their mortgage was like 10-20%, so you can't really compare the older generation's economic environment to now because money's cheap now. Money wasn't really cheap back then. It was easier to obtain, but it wasn't cheap to get like a mortgage or anything like that. I mean, honestly, I'd argue now money is more easy to obtain. It just doesn't hold as much. You just can't buy as much with it. But no doomer shit. I don't care about doomer perspectives. And I also don't care about what my grandparents did. I don't care what my parents did. I don't care what they could afford or what they couldn't afford. It's irrelevant. I care about now and the future. The past is irrelevant. It's time to move on and better ourselves. Stop looking back. Exactly. Exactly. I live in Norway, one of the wealthiest countries in the world, but prices are going up much faster than wages. Should be the other way around. No, that's not how economics works. And wages have nothing to do with anything. People have more money than they've ever had. Wages have literally nothing to do with anything. The reason why wages are so low is because people have so much money. And the people who don't have money, that's I I'm not I can't necessarily vouch for them because why aren't they saving? Why aren't they investing? Why are why are there so many like single people when you could like get with someone or like a group of people and you could actually like benefit from having a team rather than doing everything yourselves? There's a lot of factors you could discuss about this topic. If you want to go into the past, if you want to go into the past, you know, having a wife was like a normal thing, and you guys would contribute together to build what you wanted. That doesn't really happen anymore. Everyone's fucking selfish and does everything themselves. So how are you going to be successful if you try to do everything yourself? Yeah, don't get me wrong. I've gotten fucked over by so many people, so I choose to do most things myself. Not everything myself, but credit card debt highest ever. People shouldn't be using credit cards if they don't know what they're doing. Credit cards have only made me money personally with sign up bonuses and reward points. So, you know, that's people being uneducated. That has nothing to do with anything. Do I have a wife? No, but I have a team, family. That helps. My team could be larger though, you know. If a huge majority of my family wasn't so selfish, my team could be larger and we'd already be multimillionaires. It wouldn't be just me trying to become a multimillionaire. But since everyone's selfish and does everything themselves, you know, kind of stuck until something works. Dave Ramsey enters the chat. I'm not a huge fan of Dave Ramsey. Not a huge fan. He has some good ideas. He has some good ideas, but not a huge fan of Dave Ramsey. We cannot all be as educated as you. I'm not that educated though. I just have a lot of experience. I don't think you have to be that educated to do some simple shit like not get in debt, save, get your partner on board with you. Because there's also a flip side to everything I'm saying. Most people who have partners, their partners drag them down. So it's also having the right people in your life. Because I know plenty. I know plenty of people I think could be successful, but they choose to date fucking losers that, you know, you are the people you hang around. So if you're dating a loser or you're married to a loser, I'm sorry, you're going to be a loser. Like there's no way around it unless like I mean, don't get me wrong that there's ways around it, but still like you have to find the right person who sees the same vision as you as well, which is very hard to find in today's world. Am I living in a house, no debt? I mean, technically I have debt. I have a mortgage. So technically I have debt, but it's cheap debt. Like 3% or some shit like that. So technically I have debt, but credit card debt, loans, no, I don't have any of that. Same boat here. Don't get a partner in debt or just want to spend on nothing. Yeah, exactly. Exactly. Little luxuries. Getting drunk every day, smoking weed all the time, pills, eating out all the time, you know. You could learn to cook from home. The same amount of money you go and spend eating out every day, you could probably make a meal for like 2 or 3 days. So, it's also, you know, people just don't care. They just live in the moment and they don't think about the future. They don't care about the future. So you have to put blame on the individual, bro. You have to put the blame on the individual. You can't just like Don't get me wrong. I definitely think that the world is probably more difficult than it's ever been, but people make it harder than it actually is. Norway, Sweden, Denmark, and Finland have 50% single rate. They're also the happiest country in the world based on polls and charts. Interesting. That's pretty interesting. But I mean, I'm single. I'm relatively happy. I see people, the people around me who are in relationships, I don't envy them. I would actually hate my life if I was in a lot of the relationships I see other people in. So I definitely get that. But at the same time, if you found the right person, I think your happiness would be extremely high. But that's the hardest issue, or, that's the biggest issue, finding someone who is actually like a positive to your life and brings value to your life. Tough to find. Tough to find. 3% is crazy low. How do you get it so low? We did a refinance during the pandemic. Rates were really low during the pandemic. Rates were basically zero, or like 2% or something like that. Leave my weed alone. I mean, I smoke weed, but sometimes. But it is expensive. It's fucking expensive. If you smoke weed, basically every dollar you make, kiss 10% of it goodbye. Maybe even more. I have around 6% debt on my stock portfolio, but I usually get a higher return than 6% on the debt part. I mean, there's an issue with, I have an issue with that though, because you're paying taxes on your, well, if you sell any of your stocks for gains, you're paying taxes. So in some sense, paying off your debt would be better. But I think that's very situational. That's why I do meth. There you go. There you go. You don't need to worry about the future if you do meth. You'll be dead soon. You'll be dead soon. I'm married. It has pros and cons. There you go. Rates here in Norway is now over 5%. Yeah, it's like 5-6% here now, but not during the pandemic. It was cheap during the pandemic. Just got lucky, honestly. 5 to 8 euros per gram, highest pharmacy quality. Oh, it's I don't know how much euros are, but it is not that cheap where I live, bro. It's like 20-30 bucks a gram sometimes for like the pharmacy shit. Ridiculous. It depends where you live though too, because if you go to Oregon, weed's basically like mass produced there because it's been legal for so long. So you can get shit cheaper there, but where I live, it's expensive because it's technically not legal where I live. It's a medically legal, not recreationally legal. For most part, correct. Unless you grow and sell it, then it can be positive EV. That's fair, but that's illegal in most cases. So, and I also have an issue. I used to sell weed, bro. I used to make a fuck ton of money selling weed when I was a kid. But there's an issue. There's an issue with selling weed. Issue number one, you're selling someone an addiction. You're selling someone something that is not beneficial. You're using someone's addiction to make money. And in my opinion, that's a very scummy thing to do. That's very scummy to do. You know, I'm not gonna hate on you if you sell weed. You know, I've sold a fuck ton of weed like in my lifetime. I'm not gonna hate on you. But long ago I came to the realization that selling someone an addiction is scummy. And two, if you're a drug dealer, you have no friends. Basically, anyone you talk to is a drug dealer. They're only talking to you because you sell drugs. They don't give a fuck about you. When I stopped selling weed, every single person I knew stopped talking to me because they don't give a shit about you as a person. They only care about what you're selling. So those are my two issues with selling drugs. You know, the second one's not really that big of a deal. I guess that's more of just like a soul type thing. Like I feel like it's bad to have fake people around you. I think that's I don't know. It just seems evil. But selling people an addiction is I think that's wrong. I think that's wrong. And you can try to argue that weed's not addicting, but it is. Every single person I know is addicted to weed, so I don't think we can argue that it's not addicting. I'm a canister with meth I don't gotta eat. God damn it, Isaiah. You're so dumb. Holy shit. That's not as funny as it should be. Or that's not as funny as I think it is, but that's hilarious. Even if weed was cheap, you buy way more food. That's a good point, bro. I eat a lot when I be smoking. I'll eat a lot. Not one of those munchy types. I am, bro. I get hungry. Yes, I pay taxes, but there's also a tax deduction on credit. No, that's fair. That's fair. Dave Ramsey approves meth use. Situational long-term gains. First 40K plus is tax-free. That's fair. That's fair. Good point. Good point. But most people aren't holding their investments for over a year. That's a very rare person. I feel like there's a lot of short-term traders nowadays. And that's probably a majority of people are short-term traders. And short-term gains is like 20-30% or more. I think it's even more in certain countries. Strike Iran on the news. Yeah, I saw that, but I don't really want to talk about that. Is it illegal to grow for yourself at home? Yeah, where I live, yeah. You'll get like 20 years in prison or some shit like that if you get caught growing where I live. But there's certain states where it's legal. In Norway, you can make a stock portfolio account where you can buy and sell individual stocks, but no taxes until you deduct any money from it. Interesting. It's only illegal if you get caught. Fair enough. But if you get caught, you're fucked. Well, at least where I live. Where I live, you're fucked if you get caught. Customers are annoying. Yeah, exactly. It's also, I think it's, the whole point of the second part I was saying is, I just don't like having fake people around me. I've lived a majority of my life surrounded by fake people, and I don't want people like that in my life anymore. Can't argue with that, but sadly, just the way the world. It's fair, it's fair. But still, if you're in a position to not have to do that, I think it'll be better for you mentally, and maybe not, you know, maybe most people don't view this the same way I do. I used to sell alcohol to people cause in Norway you cannot buy wine or spirits after 17. So big market in the evenings, but I agree many are alcoholics and sad to feed their addiction. Yeah. Exactly. Exactly. Soul Type Thing, good band name. It's a soul type thing. It'd be like a blues band or something. Woo woo woo. In a nice way. Make sure your shares are long when GME moons. I think it'll come back to haunt US, making it legal. We have enough lazy bums. I agree. I don't like the legalization of it. I don't like the legalization of it. Not a big fan. I liked it when it was illegal, honestly. I liked it when it was like fully illegal. You seem like a good guy. Sorry for my dicky opinions. Just had a shitty week. Hey, I'm an asshole too, bro. I be shit talking so much on this stream. But it's just because, I don't know, it's funny sometimes. Sometimes it's funny. But you're good, bro. You're good. You're good, bro. How long have I been streaming? 2 hours? What do we do now? Is there anything to talk about? Shit talking's entertainment brings more viewers. No. People do not like me. You should see my comment section. I delete a lot of comments, but 90% of my comment section is just negative people talking shit on me. They do not like it. But it's because I challenge their thinking. I think it's because I challenge their thinking, and people just want to live in their little comfortable ignorance. You know, ignorance is bliss. So when you meet when you come into a stream like mine and I'm challenging your thinking, you're not going to like it. Well, most people aren't going to like it. If I was just like a little drone spouting out what everyone wanted me to say, that would bring more viewers. But me having my own opinions that don't align with most people, it's not very effective for growth on social media. You know, maybe in the long run, you know, if I keep doing this for the next like 5-10 years, maybe in the long run it could work out. But I think I'd be much better off just being a fucking echo chamber drone. I think you're a guy who's easy to hate and easy to love. That might be the nicest thing anyone's ever said. That might be the nicest thing anyone's ever said to me. That's fucking hilarious. Holy shit. Oh man, that's hilarious, bro. Easy to hate, easy to love. Oh man. That's so fucking funny, bro. Damn, crypto's still going down. Not much to talk about. I mean, we could talk about US and Iran, I guess. It's like the only thing to talk about as far as news goes right now. The fact that you mean that diversification is bullshit and that GME is the only good company in the world may light a few fuses. I do think diversification is bullshit. Wait, are you that one guy? You're that one? Okay. I was wondering. Okay, I remember now. I remember now. Okay. I do think diversification is bullshit, and I have stats to prove it. Here, let me grab a little book here for you. Which book is it? Which one is it? I think it's this one. I think it's this one. I don't know. I got a lot of books, so I don't know if it's this one or not. Let me see. I think it's this one though. Here, let me this is well, let me find it first, but I think it's this one. Is it not this one? I forget what book it is. I swear it was this one. Let me see here. Let me see if I have... Let me check the other books. Is it this one? It might be this one. I think it's this one, actually. Hey, these are good books, bro. I mean, get this one. One Up on Wall Street by Peter Lynch. But this one is Stock Market Genius by Joel Greenblatt. I think it's this one. I gotta try to find the section, though. Where the hell is it? Where's the frickin' index on this shit? Here it is. I think it... I forget which book it is, man. I think it's this one, though. I haven't read these in a while. Show the first one again. One Up on Wall Street by Peter Lynch. This is probably, like, out of any stock market book, I think, honestly, this is probably, like, the best one I've ever read. This shit's fire. But this one's also good. I just can't remember if it's... I just can't remember which book it is. But both of these are good. I've promoted these books before. I just can't remember where it is. It's called de-worsification is what they call it. I just can't find the section where it talks about it. And, yeah. I believe these are Warren Buffett's mentors, if I'm not mistaken. Or maybe not. I forget the guy that's Warren Buffett's mentor, but he's also Peter Lynch's mentor, and I'm pretty sure Joel's. I forget his name. Ben Graham. Ben Graham was Warren Buffett's mentor, and I believe Peter Lynch's as well. Where is this? Oh, is that it? Ah, I think here it is. Here it is. Is this it? All right, here it is. Here it is. I found it. All right, you ready for this shit? This shit's fire, bro. This shit's fire. All right. The Professional's Challenge. I spoke with a professional whom I considered the best in the business, a friend I call Bob, even though his real name is Rich. Bob is in charge of $12 billion of U.S. equity funds at a major investment firm. For some perspective, if you went to the racetrack and placed a bet with $100 bills, $12 billion would be stacked 20 World Trade Centers high. Needless to say, a bet that would almost certainly kill the odds on your horse. According to Bob, the bottom line and the measure of his success is this. How does the return of his portfolio stack up against the Standard Poor 500 average? In fact, Bob's record is phenomenal over the past 10 years. His average annual return has exceeded the return of the S&P 500 between 2 and 3%. At first blush, the word phenomenal and an increased annual yield of 2 or 3% seems somewhat incongruous. Though it is true that after 20 years of compounding, even 2% extra per year creates a 50% larger nest egg, this is not why Bob's returns are phenomenal. Bob's performance is impressive because in the world of billion-dollar portfolios, this level of excess return is incredibly hard to come by on a consistent basis. Some quick calculation helps expose the limitations imposed by Bob by the sheer size of his portfolio. I think this is the right part. Imagine the dollar investment in each stock position when Bob sets out to divvy up $12 billion. To create a 50 stock portfolio, the average investment in each individual stock would have to be approximately $240 million. For 100 stocks, $120 million. There are approximately 9,000 stocks listed on the New York Stock Exchange, the American Stock Exchange, and the NASDAQ, over-the-counter market combined. Of this number, about 800 stocks have a market cap of over $2.5 billion, and approximately 1,500 have market values over $1 billion. This is also an old book, so, I'm sure the numbers are much larger now. If we assume Bob does not care to own more than 10% of any company's outstanding shares, for legal and liquidity reasons, it's likely that the minimum number of different stocks Bob will end up with in his portfolio will fall somewhere between 50 and 100. If he chooses to expand the universe from which he chooses potential purchase candidates to those companies with market capitalizations below $1 billion, perhaps to take some lesser followed and possibly undiscovered bargain stocks, his minimum number could easily expand to over 200 different stocks. Intuitively, you would probably agree that there is an advantage to holding a diversified portfolio so that one or two unfortunate bonehead stock picks do not unduly impair your confidence and pocketbook. On the other hand, is it the correct number of different stocks to own in a, quote, properly diversified portfolio, 50, 100, or even 200? It turns out that diversification addresses only a portion, and not a major portion, of the overall risk of investing in the stock market. Even if you took the precaution of owning 9,000 stocks, you would still be at risk for the up and down movement of the entire market. This risk, known as market risk, would not have been eliminated by your perfect diversification. While simply buying more stocks can't help you avoid market risk, it can help you avoid another kind of risk, non-market risk. Non-market risk is the portion of a stock's risk that is not related to the stock market's overall movement. This type of risk can arise when a company's factory burns down, or when a new product doesn't sell as well as expected. By not placing all your eggs in a buggy whip, breast implant, pet rock, or Huckaboo sweater company, you can diversify away that portion of your risk that comes from the misfortunes of any individual stock or company. Statistics say that owning just 2 stocks eliminates 46% of non-market risk of owning just one. Type of risk is supposedly reduced by 72% a 4-stock portfolio, by 81% with an 8-stock portfolio, 93% with a 16-stock portfolio, 96% with a 32-stock portfolio, and 99% with a 500-stock portfolio. Without quibbling over the accuracy of these particular statistics, 2 things should be remembered. 1. After purchasing 6 or 8 stocks in different industries, the benefit of adding even more stocks to your portfolio in an effort to decrease risk is small. And 2, overall market risk will not be eliminated merely by adding more stocks to your portfolio. From a practical standpoint, when Bob chooses his favorite stocks and is on pick number 20, 30, or 80, he is pursuing a strategy imposed on him by the dollar size of his portfolio, legal issues, and fiduciary considerations, not because he feels his last picks are as good as his first, or because he needs to own all those stocks for optimum portfolio diversification. In short, poor Bob has to come up with scores of great stock ideas, choose from a limited universe of the most widely followed stocks, buy and sell large amounts of individual stocks without affecting their share price, and perform in a fishbowl, where his returns are judged quarterly and even monthly. Luckily, you don't. So, the whole point of that is diversification only matters if you're worried about risk. And diversification doesn't help you grow return. Diversification does nothing to your return. So, when I'm only investing in GameStop, I'm not worried about risk. I'm not worried about GameStop doing something stupid and the stock going down. And diversification doesn't make your portfolio any more risky than me only holding GameStop. Because if the market crashes, every stock on the market is going down. Every single one. So diversification does not matter when it comes to the overall market. Diversification only matters for the individual company. If you're buying something, if I thought GameStop could do something stupid and the stock price would crash, I would be diversified. But I don't think GameStop's going to do that. I don't think that's going to happen. And also, I think my returns are going to be better by investing in one stock. Personally. And I know there's potentially in one of these books, there's a section about that, where the less stocks you own, your gains will be potentially higher. Maybe that's just something I heard through like Roaring Kitty or something. I can't really remember. But diversification doesn't matter at all. Diversification only matters if you don't truly believe in what you're investing in. And when it comes to GameStop, I truly 100% believe that it's going to work, and I believe the downside risk is limited. So there's no point for me to diversify. There really is no point. There's a lot of other businesses I think are interesting or good, but I don't think the future gain would be as large if I was diversifying. Because I think GameStop, if you're looking on a not long enough time frame, which I'm looking to hold it forever, I'm never going to sell GameStop. unless the stock like squeezes ridiculous and, I can sell like a few shares for a relatively decent amount of money, I'm never selling GameStop. So, if I'm looking to hold GameStop until I'm dead, I don't see another there is not a single company on the market that I would be willing to hold until I die. There's not a single one. Maybe there's a few. But I don't think their gains would be as high personally, because I think a lot of those stocks are already overvalued. So, that's the whole point of the diversification topic. It's not necessarily that I think I was just annoyed that day and I was just talking shit because, I can't sit and explain to people who already have like I was saying during that Duolingo stream, I can't sit and explain to people who have a preconceived notion and think they already know everything. I can't convince them of anything. I can't help them. They already know everything. They're already a genius. So, I don't necessarily think diversification is stupid. In a lot of ways I do. Like, that's a real opinion I have. But it's not, I don't think it's for the reasons a lot of people think. I think diversification is stupid because like I said, if the market crashes, all of your stocks are shitting. Every single one. So, from that perspective, diversification is stupid. But, I truly don't think GameStop could do anything that would crash the stock price. And I think the stock is already trading at, maybe it's a little overvalued, maybe. But I think it's already trading at fair value, and book value is at $13. So the downside is essentially like 40-50% max in a market crash scenario where everyone panics and everyone sells. I'm cool with that. But I'm also bullish on the whole market. So like, I don't really see that happening. Math section's over. Reading about math. Going to look if it's available. It should be. By not putting all your money into one stock or sector, you minimize the impact of single company's failure or specific industry downturn. That's fair. But I'm not worried about that when it comes to buying GameStop. I'm not worried about that. I think GameStop, even in a market crash scenario, I think GameStop would hold its value. That has yet to be seen because the market hasn't really crashed. Beginning of last year, it went down a decent amount. But I think even in a market crash scenario, GameStop's a safe investment. So like, diversification doesn't help me. Diversification doesn't help me. I mean, how much did like Apple go down last year? Apple's basically at all-time highs right now. And it's been selling off a little bit, but beginning of last year, Apple went from 240 to 190. Top company in the world. What is that? What's that percentage? I don't know what that is percentage-wise. I think that's 30%, I believe. 250 to 190, 180. That's $60. So yeah, that's a, largest stock in the world. One of the greatest companies in the world. The stock price dropped 30% last year during like the 3-4 month little bear market stint you had at the beginning of last year. If the top company in the world can drop that much, I feel like I'm relatively safe. And, certain ones dropped even more. Like, I think Tesla dropped like 50 or 60%. Yeah, Tesla went from basically $400 to $250, like $240. Like, that's almost a 50% drop. One of the top companies in the world. So, like, there's really no safety during a market crash. There's really no safety. Like the book says, the only reason you diversify, and you said it too in the chat, the only reason you diversify is if you don't actually truly believe in the investment you're investing in. Like, I truly 100% believe in my investment. So, I don't need to diversify. I don't think there's not a world where I see that this doesn't work out. Doesn't mean that it won't happen, I'll never say that the stock can't go down. I'll never say something like that. But if on a long enough time frame, it's going to work. It's going to work. Let's see. I don't think there's a one best way to invest. It depends on what you want. If what you want is maximizing your return, diversification probably isn't it. Yep, I agree with that. I agree with that 100%. I gotta run this one back, Corey. Cool, good info, trying to catch it all. Hey, much love, Ruben. Everyone's risk to reward tolerance or long-term versus short-term. Everyone's different. Yeah. I mean, I don't think most people go into investing with the mindset of holding forever. But I'm going to hold GameStop forever. And anytime I have extra money, I'm only going to buy more, no matter what the price is. Obviously, I want to buy more at lower 20s. So them doing the bonds and the warrants and, artificially lowering the stock price through financial engineering, as a shareholder, I appreciate that because I want to buy more shares at lower prices. Busy helping people on your day off. I mean, it's not really my day off. This is just what I love to do, bro. I love hopping on stream and just talking, bro. And the fact that people are here is a blessing, bro. It's such a blessing that I can just fucking click start stream and, whether it's 5, 10, 20 people, like, someone is going to be here to talk to. Like, that's a blessing, bro. So, like, normally I don't stream during the weekends, mostly because there's nothing to talk about. But this, I would do this every single day if I could think of a way to make it entertaining every single day. But sometimes it's hard. So there's days like I don't even know what to talk about, and it's tough to go. It's tough to go live, knowing that it's potentially going to be a bad stream. You're protected from company-specific risks with diversification, and I like that because I'm a fairly safe investor. I also use asset class diversification for help with market risk. That's fair. There you go. That's fair. That is fair. But everyone has different investment goals, I'm not a safe investor. Obviously, I'm putting all my money in one stock, like, but to me it's a safe investment. From my analysis and my research and my knowledge and experience of trading and investing, mostly trading the past few years. My first year or two was a lot of investing, but majority of my market experience is trading. So through all of my experience, you know, GameStop's the only thing that makes sense. And I understand that you could protect from market risk buying like the VIX or like metals, whatever. Like I understand that, but I'm not worried about that. And like I said, I also think GameStop won't crash. Like if the market crashes, I think GameStop's a safe asset because the stock's fairly valued. And if the stock ever did crash and it went to book value, any educated investor is going to buy it. It's mostly about what makes you get decent sleep at night. Yeah, I wouldn't feel safe with as much money. I'm not like rich or anything, but I have a decent amount of money. I wouldn't feel safe being diversified in the market. I wouldn't feel safe. But there was a time, when I first started investing in GameStop where I wasn't as confident as I am now. So it also has evolved as the due diligence gets stronger, the business gets stronger, my confidence grows. But there was a time where I wasn't as confident as I am now. I was still confident, but I'm curious to hear about your thoughts on GameStop. Why are you so optimistic? Because I think Ryan Cohen and his team is going to perform similar to Berkshire, and they care about their shareholders, and they want their shareholders to succeed. And there's a lot I could say about this. That's a very broad question, but I think a lot of businesses out there, the management is in it for themselves and they don't care about shareholders. So that's part of it. There's like 100 things I could say. There's so many things I could say. Like I said, that's a pretty broad question, but what it comes down to is I believe in the team. I believe in the management. And, they went from losing hundreds of millions of dollars to now being profitable hundreds of millions of dollars. They have the best financial engineering I've ever seen, ever. So, like, there's a lot of things. There's a lot of things. Ryan Cohen's a genius. He's a genius. And maybe he's not a genius, but he's a smart person. He's a smart investor. He's knowledgeable on finances and the market. He's knowledgeable about the space he's in, retail. And with all of those things combined, and also a care for shareholders, which I truly don't think most businesses have. Like, I don't think most businesses give a fuck about their shareholders. I just don't see how I could lose. I really don't. And also how negative people are towards GameStop. That makes me even more bullish because people are generally wrong. In my experience, people are always wrong. The herd is always wrong, I should say. Market crash could be great for GME. GameStop's a cash rich and would love to buy companies on the cheap. Yeah, exactly. Exactly. They could buy back, and if not that, they could buy back shares. You know, they could buy back shares. I don't think GameStop will do that. I don't think they'll do that. I don't think that's the goal, but they could, and that would hold the stock up during the market crash. Michael Saylor sleeps well at night because he's convinced that Bitcoin is the best investment of all. If that works for him, I respect him for it. I mean, that's fair, but there's a big issue with those treasury companies. They're using debt to buy Bitcoin, and anyone who like shorts markets, all they have to do is just suppress the price for the next 5-7 years, and any treasury company that raised debt to buy Bitcoin is fucked. I mean, it's probably more their shareholders that are going to get screwed over, but they're all screwed. So if you're like someone who shorts markets, and you could go back to the streams when Bitcoin was at all-time highs, I was saying the same shit. Anyone who shorts markets can see that, and that's like the easiest short in the world. And also Bitcoin has no value. The only reason Bitcoin has value is how much it costs to mine it, and the potential of easy money transfer to people who don't have access to banks. But crypto in general has only been a negative, in my opinion. A lot of scams, a lot of people got extremely rich from very small amounts of money, and that's why everything's so expensive. Crypto has only been a net negative to the masses. Maybe age is a factor too. Closer to retirement, do they diversify more? Probably. I think that's a tough question, though. I think that's a tough question. Would Berkshire Hathaway start a position in GME? Nah, they couldn't build a big enough position. Like, if you buy 5% of the company, which is like 20 million shares, I believe, somewhere around there. If Berkshire came in and bought 20 million shares, $20, that's only 400 million. Like, that's not going to move the needle for Berkshire. They need to be able to put billions of dollars into it. So I just don't see that happening. That's 400 million is like, Berkshire wipes their ass with 400 million. Like, that's just nothing. Sure, the investment could turn into a couple billion, but that doesn't move the needle for a $1 trillion conglomerate. So, the only way GameStop would be able to get a big investor like that is if they increase the share float. So if anyone, is crying about GameStop diluting, in the long run, that's only going to help, because if they bring enough shares into the market, maybe someone like Berkshire could buy enough shares where it would move the needle for them. Because we're supposed to be going to a billion share float. What's 5%? I don't know exactly. What's 5% of a billion? 50 million. So you could buy 50 million shares. 50 million, right? See, I think I did math. I think I did the math wrong the first time. But 50 million shares times 20, that's a billion. Like, even that's not enough, I don't feel like. Like, that, I just don't think that would move the needle for Berkshire. That's getting closer, I feel like. Because if GameStop's potentially a 5-10x, that's 10 billion, 5-10 billion of shareholder value to Berkshire shareholders. So, you're getting up there, but even a billion share float, I don't think is enough. And obviously all these numbers will go up as the price, if the price increases. So, as the price increases, maybe they could put in enough, but I don't think so. I think we'd have to have a much larger share float for something like Berkshire to invest. and stay under 5%, unless they want to be an over 5% owner and file the 13 G's or whatever, that's fair, but they can't go over 10%. They can't go over 10%. Risk appetite would change. Typically, you shift away from equities towards fixed income with age. Yeah, that's fair. That's fair. But what if your investment is still continuing to grow? Like, what if the business is still continuing to grow? There would be no point in shifting, because, like, you could just sell calls. You could just sell calls. You could live your life selling calls, and the only risk is that you have to sell some shares if it goes against you. So, like, I agree with you in some ways, but if you have a real good solid business that's going to grow forever, you never have to sell. Legit. Because there's ways to make passive, there's ways to make income from that investment. What was Apple's low? Apple used to be a penny stock. Protection against ignorance, Warren Buffett. Wait, what? Diversification, protection against ignorance, Warren Buffett. Oh, okay. Stocks can go to infinity, but they can only go down up to 100%. That's asymmetry, baby. I think book value is really important, though, because, like I said, any educated investor would buy basically any stock on the market for book value, let alone a growing company that's only profitable. There's a lot of stocks that are under book value, but the businesses are declining, so that's a completely different investment. If you could find something that's profitable and growing at book value, that's like a no-brainer investment. You don't even have to think about that. That's a statement to chew on. Regarding Bitcoin, one can argue why it holds value, but it's got to have something that appeals to people. Since it went from 0 to 128K, has anything ever in history done something like that? I don't think so. But how many people do you think actually gained from Bitcoin going from 0 to 128K? I bet I don't know the stats. I doubt there's a stat for this, but I almost guarantee more money has been lost on Bitcoin in the past 5 to 6 years than was made from going to 0 to 128,000. I can almost guarantee that. Because Bitcoin going from 0 to 128,000 brought in a bunch of wannabe traders, wannabe investors who have no clue what they're doing. And I guarantee a lot of them probably bought Bitcoin and the price dropped, and then they sold for a loss. And then the price kept going up. And rinse and repeat. I can almost guarantee more money has been lost on Bitcoin than money that's been made. Almost guaranteed. Like I said, there's probably not a stat for that, but I have a hard time believing a lot of people benefited from the crypto rally. Value is a human concept. It exists where people agree it exists. Bitcoin's still new compared to traditional stores of value, gold, silver, and real estate. But gold and silver, in a lot of ways, don't have much value. The value's in the scarcity. And I guess gold and silver, you actually use it for certain things, but what do you use Bitcoin for? You don't use Bitcoin for anything. It's a chart on a, it's a number on a screen that goes up and down. What is Bitcoin's use case? It really has no use case besides sending money to people who don't have access to banks. Making transactions of sending money back and forth a little bit faster, I guess. Well, quite a bit faster. But there's not much use case for Bitcoin or any crypto for that matter. But you're right, value is a human concept. But when it comes to business and stocks, when it comes to business and stocks, value is the business. The value comes from what the business produces. GameStop stock is worth $13. There's no argument against that. That is how much GameStop stock is worth. $13. But the stock market prices in the future. GameStop's book value in 3 years ish will probably be around $20. Most likely. So I agree with you, but when it comes to business and stocks have a real value. It's not just some made up thing. You can theoretically make money trading anything depending on the strategy deployed. I can't say Bitcoin is worthless, but it's definitely uncertain. I agree with you. You can make money in anything, but most people lose. The statistics show majority of people lose when they're short-term trading. Most Bitcoin holders today are in minus. Most likely. Very likely. Tulip mania. There's more people in Bitcoin, make the mania stabler for longer, but how long? I mean, that's why I'll never invest in it. And investing in GameStop, in some ways, they got a little bit of Bitcoin on the balance sheet, so in some ways I am invested in Bitcoin. Fractionally invested in Bitcoin. If you think about it from that perspective, I am invested in Bitcoin because GameStop bought it. But I would never buy Bitcoin ever. In Iran right now, currency's worthless, so they're using Bitcoin. Yeah, see? So there's a use case. Ethereum has a lot of use cases. The blockchain ledger itself has a lot of value. Yeah. I mean, I guess when I'm saying that Bitcoin has no use, I'm more saying that it doesn't produce anything. Like, of course it has use. Same with Ethereum. They have use. There's, reasons why people buy it and people are bullish on the future. But it doesn't produce anything. Bitcoin, isn't a business that makes money, makes profit, grows assets. It's just a number on a screen with what is it? 20 million in circulation. And there will be 20 million in circulation forever. So it's more of like a scarcity type thing in a lot of ways. But I guess when I'm saying that crypto has no value, I'm mostly just saying it doesn't produce anything. Any stock on the market has a business behind it that makes profit, assets. You can do As we've seen with GameStop, you can use financial engineering to make your business even better and even more profitable. Look at GameStop's balance sheet. You know, we go to GameStop's balance sheet. Where the fuck is this shit? You ready for this? You ready for this? Let's go back to last year's 10K. Y'all ready for this? Oh, it's not that one. It's not that one. My bad. Y'all ready for this? All right. So the 10K from 2024. Y'all ready for this? Y'all ready for this? They went from losing hundreds of millions of dollars 2023, 22, 21, 2020, 2019. Basically 7-8 years of losing hundreds of millions of dollars. They make their first profit February 3rd, 2024. Only 6.7 million. You know, that's nothing. But this is the whole let me blow this up. Let me blow this up. This is the whole point of this. Profit doesn't really matter. Look at stockholder equity for 2024. 1.3 billion. All right? 1.3 billion. So that's I don't remember how many shares did they have? Where is it? 300 million shares. So I think you do 873,200 divided by, I forget exactly what it is, 1388 billion. Is that right? 22. I don't know if I did that right. 22. It might be 22 cents. Let's see. Let me do it the other way around and see. 305, 873,200. So back in 2024, GameStop's share value was $4.50, essentially. $4.50. Now check this shit out. Check this shit out. Where is it? Okay, so is it this one? No. So Q1, not relevant. Is it? I think it's Q2. After the stock squeeze. After the stock squeeze. Look at this. Look at this. Notice something? Do you notice something? Do you notice something? They raised $3 billion of shareholder value in 1 quarter through financial engineering. Meme stock or not, whatever, stock squeeze, you can say all you want about how they did this. They raised $3 billion in shareholder equity. 1 quarter. 1 quarter. 3 billion. 3 billion. Do you see why, like, stocks are, you know, the most valuable investing asset? Especially with someone who actually knows what they're doing as the owner of the company or CEO. If you had any other CEO, any other board, this would have not happened. This wouldn't have happened. You wouldn't have made $3 billion of stockholder equity in a quarter. Any other company wouldn't have done this. This is why business is so valuable to invest in. Because of stockholder equity. Crypto can't do this. Crypto can't squeeze and raise a bunch of equity for the people who hold Bitcoin. They just can't. You only get this from the stock market. Bitcoin can't use bonds to raise money. Bitcoin can't issue warrants to potentially raise money if the share price goes up. Crypto in general. Crypto can't do this. The stock market and business in general is the place to be. If you're looking at the future, sure, Bitcoin might go up in the future. Bitcoin might be worth 200, 300,000 in 5-10 years. I don't fucking know. But all I know is I want to invest in something where the risk is limited, and as the company grows, the risk decreases. And if I'm looking on a long enough time frame, GameStop has no risk. Zero risk. When GameStop starts, if GameStop gets to the position where they're making $1 billion, $2 billion a year or more, this is a risk-free investment that could potentially grow substantially. There's just nothing like that. There's just nothing like that. Not a single stock on the market like that. Every other company in the market has the opportunity to do that. Palantir's sitting at a 200 billion, 300 billion? I don't fucking know. 328 billion market cap. Palantir's smaller than GameStop. Palantir could right now, I mean, obviously they should have did it at all-time highs. They could raise hundreds of billions of dollars and put it on their balance sheet. And, the stock price would drop, but any real shareholder would have so much equity into the company that if you're a real Palantir shareholder, you would not care. And they would have hundreds of billions of dollars to, just hold. They could hold it with cash and be making tens of billions of dollars through interest. Like, you could do so much with that. But they don't. Why? I don't know. Maybe they're worried how their shareholders would think, whatever. I don't really know, but so having someone like Ryan Cohen who knows the people who like actually care about GameStop will respect his decisions. I mean, if the stock squoze tomorrow, and they dilute it again, I'd be hyped. I'd be hyped, bro. I'd be so excited. All right, later, Kai. Later, bro. Have a good one. Hopefully you learn some stuff. Oh, what's up, Muma? What's up, bro? Whole banking system will be on the blockchain, probably ETH and the RWA, and tokenization of stocks will be on the blockchain too. Maybe. Most likely. But maybe. Sure, in the long run, I can see it replaces a lot of weak currencies. I get the thesis, but is Bitcoin a permanent solution for the currency or a temporary stopgap? I don't think it could be a permanent solution. But I don't know. With most things that are similar to crypto, like Pokemon and like gold and stuff, its value is potentially driven because currencies are weakening. What's going to happen if currencies start strengthening? In a few years, one can buy GME on the blockchain 24/7. I mean, GameStop already has 24/7 trading besides the, the weekends. But that's not going to do anything. That's just going to make it more volatile, if anything. It's not really going to change much besides the volatility. Somebody has a bad weekend, they'll sell. Whatever. Is the government invested in Bitcoin? Yeah. But it's all, I don't think the government's actually bought Bitcoin. They just seized it through like people who doing illegal shit. I don't think the government's actually, the US government. I think there's other governments that have bought Bitcoin, but I don't think the US government has bought any Bitcoin. All the Bitcoin the US government holds is seized, or has been seized. GME holds Bitcoin. That's more than enough exposure for me. Yeah, I agree. Scarcity type thing, not a good band name. It's been stated already that Bitcoin is a commodity, not a security, and commodities don't produce either usually. That's fair. It's very fair. But my whole point of that is I'd rather invest in a business, not a commodity. That was the whole point of that. Let's say, legit question. If you wanted to give your grandmother Bitcoin for free, how easy is that for you to do? With Venmo, it's pretty easy. But that's about it. If the process becomes super frictionless, I'll buy a little more into the Bitcoin thesis. Yeah, I guess it depends how and if banks start to integrate it into like accounts or something. But most people, most old people, I don't think would have like a JP Morgan bank account if they got an offer to open like a crypto part. I don't know if they would do it. Like if I wanted to give my grandmother some cash, it's pretty straightforward on how to do that. Yeah, good point. Bitcoin's supposed to replace currency. That's an attribute of currency I think it should have. I don't think it'll ever replace currency. Currency's always going to be a thing. I think people are very wrong about currency being worthless. That's why seasoned investors won't invest in Bitcoin. They can't measure it or follow it or forecast. Well, institution investors are buying it now. I think there was a lot of legal issues as well. But there's a lot of laws and stuff that have been put into place where institutions are now buying Bitcoin, but it's only been going down since they started buying. So, like how relevant is it really? I guess, time will tell. But if Bitcoin went back up to all-time highs tomorrow, I would still think it's trash. I would still have the same opinions. I had the same opinions when it was at all-time highs. The price fluctuating isn't going to change my opinion. It could go up to 1 million. I would still think it's garbage. I don't care, bro. A price going up or down on a screen doesn't do anything for me. Doesn't change how I think about anything. Damn, a 3-hour stream on a Saturday? That's crazy. Alright. Is there anything else to talk about? Let's see. Nothing there. Oh yeah, I found that article that I wanted to read. Where did it go? I haven't read it yet. Where is it? Somewhere here. Where is it? Ah, this. Think friend, buddy, pal, planter. It's planter. It's planter. I know what you want me to say. I know what you want me to call it, but it's planter. YouTube Shorts and All right, you ready for this one? YouTube Shorts and Instagram Reels are making you dumber, according to science. A study from scientists at China's Zhejiang University showed that short-form video content is directly impacting viewers' attention spans, and not in a good way. Brain rot might actually be a real thing, not just Gen Z slang. The 2024 study has started to make waves online 2 years later, thanks to its harrowing findings, which show that consuming short-form videos, such as TikToks, Instagram Reels, and YouTube Shorts, negatively affect your brain's attention span and executive control. Study shows correlation between short-form content and low impulse control. The study consisted of 48 participants, made up of 35 women and 13 men, with an average age of 21.8 years. All participants reported regular use of social media and consumption of short-form content. These 48 people completed assessments and questionnaires about their tendency toward addictive short video use, as well as a self-control scale that measured their capacity for behavioral self-regulation. They also underwent more scales that measured their impulsivity, stress, mind-wandering, attention control, and anxiety/depression. After that, the participants undertook an attention network test, which consisted of 192 trials that measured how they maintained vigilance, spatial focus, and executive control via EEG. What the study found is fascinating. Users on social media, those who reported higher instances of consuming short-form video content, were more likely to have less self-control, scored low on the test's focus section, and showed weaker activity in the frontline midline region of the prefrontal cortex, the core of the brain's focus and control center. These results suggest that an increased tendency towards mobile phone short video addiction could negatively impact self-control and diminish executive control within the realm of attention functions, the study reads. The study sheds light on the adverse consequences stemming from short video consumption and underscores the importance of developing interventions to mitigate short video addiction. While this doesn't literally mean that TikTok is actually destroying your brain, it does show a proven correlation between lower impulse control and lack of focus in those who regularly consume short-form videos. There you go. Okay, that's all. I wanted to read that. I wanted to read that because, I mean, find anyone who watches short-form content. It's pretty common. Pretty common. I don't think there's anything else to talk about, though. I don't think there's anything else to talk about. Oh, wait, I gotta pop this up for the thumbnail. Gotta pop this up for the thumbnail. So, yeah. I hope you stub your toe later. Maybe I will. Hope you have an awkward encounter with a stranger. Hope you think of the perfect comeback to an argument from 5 years ago with no ability to deploy it. Good Lord, Grady. Wishing so many bad things on me, bro. Just because I like saying Palantir instead of the way you want me to say it. I know how to pronounce Palantir, but I just don't want to pronounce it that way. I like the way I say it, and I like it even more that it upsets you. I like it even more that it upsets you. It makes it funnier. What's up, Hugh G? Talking about that peanut company. What, you don't like Palantir? You don't like Palantir, bro? You got a problem? You got a problem with Palantir, bro? What's up, Hugh G? How you doing, bro? How you doing, Mr. Hugh G? Whoops. Mr. Hugh G. He's got a cool monocle. Yeah, bro. Yeah, bro. He does got. I also like the. I like the peanuts, bro. They're good. Especially the honey roasted ones. The honey roasted ones are fire. So this is Greg Abel's shareholder letter to Berkshire. Blech. I can't make a good intro for this. This is Greg Abel's first shareholder letter to Berkshire Hathaway shareholders. To my fellow Okay, that's where I started. I mean, how come you don't complain about the way I say Berkshire? A lot of people say Berkshire. Oh, I think it's time to get out of here, chat. Just walk my girl to the train and got a few midday Guinnesses. Rare Saturday stream I see. Any good takeaways from Berkshire? Not really. I'm just surprised at all the companies they own. And it's, you know, interesting to see what the potential future of GameStop is, maybe, you know? Maybe. We'll see. Like, what happens if GameStop raises $31 of shareholder value in a year? Like, that's crazy. That's a 120-ish% increase in shareholder value if you're buying around the prices it's at right now. Sure, you know, it'll probably be 20, 30 years down the road, maybe 40 if that ever happens, but still 20% average annual return. What if? But I think I'm going to get out of here. I've already been streaming for over 3 hours. But I appreciate you guys. Thanks for stopping in. Surprised to see some people in here on a Saturday. So, thank you guys. Really appreciate you. I probably won't stream tomorrow, but I'll see you guys on Monday. Later, Hugh. Much love, bro. Later, Grady. Later, Ruben. Later, Muma, if you're still here. Rosh. Later, bro. Have a good one. Enjoy your weekend. Yep. I'm out. Appreciate you guys. I'll see you on Monday. God bless ya. Peace.